Ladies and gentlemen, good day and welcome to Mart India Limited Q3 and 9M FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Karan Bajaj. Thank you, and over to you, sir.
Thank you very much. Good evening and a very warm welcome to everybody present on the call. Along with me, I have our CFO, Mr. Premchand Devarakonda, and Strategy Growth Advisors, our Investor Relationship Advisors. We have uploaded our results and investor presentations for the quarter and 9 months on the stock exchange and company's website. Hope everyone had a chance to go through the same. To begin with the update on the store opening front, in Q3 FY24, we opened 7 MBOs. Out of this, 4 MBOs opened in Andhra Pradesh, 2 opened in Telangana, 1 specialized MBO, Kitchen Stories, in Delhi NCR. Our company is currently associated with more than 100 electronic brands, with over 8,000 SKUs, and has a long-standing relationship of more than 15 years with a certain number of brands, which operate in product categories such as large appliances, mobile phones, small appliances, IT category, and others. In 9 months FY24, we have opened 21 stores. Our store count at the end of December 2023 stands at 147 stores, 134 of which are MBOs, 13 are EBOs. Out of 147 stores, 125 stores are leased, 11 are owned, and 11 are partly owned and partly leased stores. As on date, we are present in 58 cities across 4 states. Coming to Q3, we have delivered robust growth of 21% in revenue year-on-year at 1789 crores and 16% year-on-year for 9 months FY24 at rupees 4791 crores. Our EBITDA for Q3 FY24 stood at 115 crores, and for 9 months FY24 it stood at 342 crores. EBITDA margin stood at 6.4% for Q3 FY24 and 7.1% for 9 months FY24. Our SSG for the quarter stood at 13.4%, and for the 9 months FY24 stood at 10.1%. We are concentrating on strengthening our position in the areas where we currently operate before exploring newer markets. This strategy has allowed us to establish our brand in the markets of Telangana, Andhra Pradesh, and Delhi NCR. This is not only helping our customers in those regions to connect with our brand, but also to familiarize them with our range of products. It enhances our understanding of the market and the preferences of our customers. Our future plans involve further expanding our store network in Andhra Pradesh, Telangana. Additionally, we aim to gradually extend our presence to the NCR region as well. Following our focused strategic expansion based on defined clusters, our knowledge in local market dynamics, efficient supply chain management, and strategic inventory control have contributed significantly to achieving cost competitiveness and consistent profitability. The customizations of a product assortment and maintenance of a comprehensive portfolio play a pivotal role in securing enhanced visibility, brand recognition, deeper market penetration, and an expanding customer base. With this, I request Mr. Premchand Devarakonda, our CFO, to update you on the financial performance. Thank you.
Thank you, Karan sir. Good evening and warm welcome to all the participants. Now, I would like to present the financial overview of the company. Our revenue from operations for Q3 of FY24 stood at 1789 crores as against rupees 1482 crores with a growth of 21% year-on-year. For 9 months of FY24, our revenue stood at 4791 crores as against rupees 4118 crores, has a growth of 16% year-on-year. EBITDA for Q3 of FY24 stood at rupees 115 crores as against rupees 73 crores, a growth of 58% year-on-year. And for 9 months FY24, EBITDA stood at rupees 342 crores as against rupees 245 crores, with a growth of 39% year-on-year. EBITDA margins for Q3 FY24 stood at 6.4%, and for 9 months of FY24, it stood at 7.1%. PAT for Q3 FY24 stood at rupees 46 crores as against rupees 22 crores, as a growth of 109% year-on-year. And for 9 months FY24, PAT stood at rupees 143 crores as against rupees 87 crores, with a growth of 65% year-on-year. ROCE and ROE on an annualized basis for 9 months of FY24 stood at 20.6% and 14.4% respectively. The working capital days as on 31st December 23 stood at 53 days. The gross debt to equity as on 31st December 23 was 0.33x, and net debt to equity was 0.26x, and our net debt to EBITDA stood at 0.77x. Our cash flow from operations for 9 months of FY24 stood at rupees 312 crores. For 9 months of FY24, same-store growth rate stood at 10.3%. For this 9 months period, our about 44% of our revenue came from large appliances, 42% from mobile, and 14% from small appliances, IT, and others. In Q3 FY24, around 99% of our revenues came from the retail segment, and the top 5 brands contributed around 60% of our revenues. With this brief presentation, I open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Srinjana from Ratnatraya Capital. Please go ahead.
Yeah, hi. Congratulations on the great results, sir. So my question was on the gross margin side. There is some expansion on the gross margin, even if you see year on year, 1% sort of went up. And in terms of mix, if you see, the mix change has not been favorable particularly. So can you explain that a little bit? What would
Hi, can you repeat your second part of the question, please? I could not get that.
Yeah, so I was just asking on the gross margin front. The gross margin has expanded year-on-year basis from 13% to 14.2%. And in terms of mix, the change in the mix is not in the favorable, right? Because the phone's share has increased. So can you explain that a bit?
Yeah. So, see, there are two things here. As you correctly said, the gross margins have increased. So even if you look at a previous quarter, the gross margin was a little high compared to this particular quarter. So there are two major quarters that have a better gross margins that usually we have seen in the past. But now what has happened is because we've improved a lot of other product categories, which deliver us a higher margin, so blended margin overall would look better. So I would say it would remain in the similar range going forward as well. But definitely since the time, in the last couple of years, we've worked really hard to make sure that the product mix is optimized. We emphasize more on margins and make sure that our gross margin levels increase. So that is what we've done, and that is what you see the delivery today happening because of that reason. The work that we've done in the last couple of years to make sure that our gross margins from a 13.7, 13.8% increased to 14.1, 14.5%. So that is what we had worked towards. And on the second question for the product mix would be definitely as the mobile phone as a category is increasing. But at the same time, what we've done is we've tried extracting more of accessory business, screen guards, tampered, chargers, cables. We're adding up those categories as well, audio categories, headphones, TWS, along with mobile phones and an attachment. So usually when you attach up that particular category along with mobile phones, you would definitely see an increase in margins there as well. So all that put together helped us, increase our gross margin, even though the product mix got a little varied towards mobile phones in the last quarter as well.
Right, understood. And congrats on the great delivery, sir. Just one more follow-up on this. So on the last call, I think you mentioned that there is some accounting change also, wherein the incentives that we were earlier recognizing as a part of the sale, now in the bill value itself, we are getting the deduction there, so that gets subtracted from the cost. So is that also affecting the margins in figures? Or is
So if I say another way, what was happening is not from the sales, but from the purchase that we used to take in. Now it comes into invoicing, not as a separate credit note that we used to get. So you would see a little dip in the incentive incomes that we would be receiving in the last few quarters. It's because now most of the brands are trying to push them to invoices everything in the bill itself, so that the other operating incomes become a little lesser. That was the plan, and so that the cash flows also get better. So that was the whole plan. But we're trying. But a lot of brands, because we've been working with them for so long in the same accounting practice, it's very difficult to change them now. So the major component still remains on invoicing, but there are a lot of other schemes like sell in, sell out, cash discounts, price drop schemes, defective schemes, marketing, and everything comes as the post sell out, post sales support for us.
understood, sir. Thank you very much.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Sanika from Sapphire Capital. Please go ahead.
Hi, sir. In the previous calls, we had given a margin guidance of 6.7% to 7% going forward, and this quarter we can see a slight dip in the margin. So is it because quarter 3 is seasonally weak or something, and going forward, can we expect to come back on track to 6.7 to 7% kind of margin?
Yes. Hi, Sanika. So, Sanika, this quarter is a little heavy. If you talk about the EBITDA margins going a little down compared to the previous quarter, that definitely would be there because we went a little aggressive on our marketing strategy that we had planned. There were other costs like business promotion and all would be little higher and directly proportionate to the business that we would do. And this being a festive period, all retailers and the market is a little more aggressive in terms of discounting and in terms of promotions and all. So that is where we had to put it under the same way. So that is why you would see that 0.2-0.3% difference in that number. But I would say things going forward also would look similar. And this being the largest quarter for us in terms of revenue, also we had to make sure that our marketing spends are higher, especially in Delhi. So subsequently, Delhi we spend around 5.5 crores additionally than our budgeted number for the cost of marketing that being higher compared to the regions that we operate in AP, Telangana, and Hyderabad. So so you would see definitely a dip. But again, it is in line with the gross margin that we had expected and the expense that we would bear for that particular quarter, looking at the revenue that we generated.
Okay, so going forward, we can expect to come back to our stated guidance, right?
See what happens is like this coming quarter, Jan, Feb, March, like for example, last year, our marketing spend would be similar, for example, but then this year if the summer starts a little early in this region, then we would need to expand our marketing budget. Like last year, the marketing budget got split into 2 quarters, majorly because Dussehra and Navaratri started in September. So our marketing budget got split between 2 quarters in Q2 and Q3 for festival period, because whereas this year it was strictly only in 1 quarter. So you would see that impact of the cost going up for a few things. Same thing with summer this year, like Jan, Feb, March. Right now it is a little cooler in Delhi and North region, so our spends are next to zero there. But if you look at South, probably next 15-20 days we start the summer period here, and according to the sales growth, we would look at expanding and promoting with cashback offers and marketing and all of that. So then it is more like a seasonality of a business that would come in. And then definitely then there would be a little less or a higher number in the Q1 of next financial year. So it is more of seasonality, but we would remain in the same range, and it would all depend on what the sellout is and what the revenues that we're generating on the floor on a daily basis.
Okay, okay. And for the next 2-3 years, what kind of revenue potential are we looking at, and what are our expansion strategies?
So our expansion strategy would be to open around anywhere between 25 to 30 stores comfortably. So we've already identified a lot of stores in the existing markets that we're operating today. Like for the first 9 months of this year, we've opened 21 stores. Last quarter itself, we opened 7 stores, and there are another 7 to 10 stores that are in pipeline to open up in this quarter. So, on this year count, we would be upwards of 35 stores that we'll be launching, and kind of a similar number in the next couple of years. That's the plan. But most importantly, we don't attribute our growth coming in from the newer stores. So if I just give you an example, last quarter on a growth of almost 300 crores, the contribution coming in from the 7 stores that we opened in Q3 was hardly 11 crores. 10 to 11 crores. The rest of the growth came in from the existing stores. So usually we would attribute the store growth in the next couple of years from the new stores that we open in the last 12 months from that particular year. So that is what we look at. And number 2 would be we would look at a very comfortable number of 15-18% kind of a growth coming in for the next few years very comfortably. Until unless there is a new technology product that comes in or a new change in technology that helps us grow better. But what we see in next couple of years, the product or the technologies would remain same. So that is where we would see this kind of a growth coming in from the existing stores.
Okay. Okay. Thank you, sir.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Krishna from Capital Mind. Please go ahead.
Yeah, hi sir. Am I audible?
Yes.
Hi. So first, congratulations on great set of numbers. We can see that operating leverage is kicking in slowly. So I have a couple of questions. I'll start with first one. So, sir, what is the number of months it will take for the new store to break even on operating front?
Okay. So, Krishna, there are two things here. So, the existing market that we are operating, say, suppose Hyderabad, AP and Telangana, the brand is recognized, right? So, here we will look at a 10 to 12 month kind of a break-in period. Whereas the newer markets that we are operating, like in Delhi NCR today, from the first store till what today we are at, we've seen the projected numbers to go around 18 to 20 months, and that is what we're delivering today. So, now once we establish the brand is more recognized, the more number of stores we keep adding, after that, then it will come on to a similar level that we would expect in our existing geography. But right now in Delhi NCR region, it would be around 18 to 20 months, and AP Telangana region would be around 12 months.
Got it. So my second question is that you said the current number of stores on the North cluster is generating around 0.2% EBITDA margin. But you are expecting that to slowly move to the current 7% range, which the South cluster is managed to get it. So any timeline you have it, sir? The current 20 stores which we have in NCR, when can we see the margins to go from current 0.2 to around 7%?
So Krishna, right now these stores have been operational for around 14 months. We have another 7-8 months of breather for these stores to grow. So right now we are quite confident because last quarter also it was a similar number. And then once the summer sets in, because last year we missed on the summer period in Delhi because it was cold then and started pouring a little early. So North summer went for a toss last year, especially the cooling products where we have the highest margins. This year we're expecting that to be in line with our expectation of sellout for ACs and air coolers. That will fetch us a little more higher margins. So I think we would like to give it another 6-8 months for it to develop further and come up to the same level as what we're operating back home in Hyderabad.
Got it, sir. Got it. I just have 2 more questions, sir. So one is that so I can see that we are slowly getting our presence in Kerala. So is that our next area of growth, sir, region of growth in Kerala?
No, Krishna, Kerala was just an acquisition for the existing business of Hacker, the kitchen business that we are into. So that was just a franchisee takeover from them. So there's no other plans of opening a multi-brand stores right now there. We are concentrating only on Delhi NCR and AP Telangana as a region.
Perfect. Perfect. So one last question. So you said the majority of the growth will come from the existing stores. So and because the new stores will have some time to mature. So and we have been doing same store sales growth upwards of 13-14%, which is really healthy. So do you think we can sustain this same store sales growth about 12-13%, sir, for the next 2-3 years?
So Krishna, I hope we sustain that kind of a number, but then see, like this year it definitely helped us with the 5G rollout, So the ASPs went up, 5G rollout was good, large screen televisions during the World Cup sold really well. So a lot of categories, audio picked up, accessory picked up, so a lot of categories apart from the core business also picked up and started doing very well. So we're concentrating on those businesses as well to develop in the existing time from the existing stores. But because the stores are at a very high base anyway, it becomes very difficult for it to, keep sustaining at that level. But at a 10% growth is what we're quite comfortable with, try to achieve that number at least, going forward.
Got it. Got it. Yes, sir. Thank you. That's it from my side.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Manoj Gori from Equirus Securities. Please go ahead.
Yeah, hi, good evening, sir. So
good
my
evening.
question is on the Delhi market. So, see, if I look at the EBITDA margin performance, probably for the first half, you said you have done somewhere around 0.4% kind of EBITDA margin, which currently for the 9 months it's close to around 0.2%. So obviously indicating that there have been some losses into Q3, and probably if you look at this was seasonally in terms of festive season, it was a heavy quarter for the Delhi stores. So though the store say a revenue growth seems on the higher side at 60%, but do you feel like it was somewhat below our expectation and probably the scale was benign and accordingly we faced challenges in terms of EBITDA?
Hello, sir. So, sir, yes, definitely, yes. As you said very correctly, if I look at the blended EBITDA margin that we delivered this quarter, particularly and for the first 9 months, it comes out to 0.2%, would look a little lower than the last quarter. Is because those we had generated revenues of around 55 crores last quarter versus 83 crores this quarter. The numbers on the top line definitely were higher, but then at the same time we spent over 5.5 crore rupees on advertising, which was not attributed in Q2. So if I look at that number itself, that itself is around 4%. So that itself is a very big number. So we could have added more stores which are in the pipeline. So once the stores are going to come in, probably next Q3, if you look at it, we'll have a similar marketing budget, but with double number of stores available there for us to sell. So it is a strategic plan that it is more like an investment that we're doing right now, to make sure that the brand is recognized and the stores that are in the pipeline that we're opening in the next couple of months or also, they sell out really well at the beginning. So it was a strategic move. We could have saved this money. We could have saved a little more money here and there and made this number look better. But our strategy was a little different. We're looking at a long-term strategy for Delhi. So Delhi has to be given 2-3 years for it to grow. So we're nourishing the baby right now. So this is an investment that has gone through and we're quite happy actually with the performance that we've done in Delhi.
Right, sir. So in the medium term, probably from FY25 or FY26 point of view, looking at the complete Delhi operations or the North market, how do we see margins moving up? Probably any aspirational targets that you have set, or probably given that you would be having a strong visibility on the overall markets, where do you see this margins moving? Probably from 2 years, 3 years, like not any specific number if you can highlight, but at least some trajectory, whether it would be towards mid-single digit, anything on that.
So, sir, right now, if I look at the existing market, we are hovering around 7% plus. And if I start comparing that, because the productivity per store here on an average is upwards of 60-70 crores, in Hyderabad city, 40 crores in the Telangana upcountry market and 32 crores in the Andhra Pradesh market. So what happens is that if I calculate the cost of running the stores, expenses, rentals, manpower, electricity and all that put together versus Delhi as a market, so the cost of running all these stores are a little expensive there. So if I look at the actual number there, I would not expect it to reach 7% mark immediately in the next 10 months, 12 months or 14 months. But it definitely would be upwards of what it is today. And what would happen is that even if these existing 13 stores that we operate today are 12 multi-brand and 1 exclusive brand outlet, even if they become profitable in the next 10-12 months and start giving out the higher number of EBITDA, what would happen is the newer stores will pull down these numbers. So because we need for the next couple of years, our plan is to add up to 20 plus stores, 14 are in the pipeline, 6 open up in the next 45 days. and then an additional of another 10 stores in FY25-26 as well. When we keep on adding up these stores, a total of 40 stores operation, 35 to 40 stores operation in the next 3 years, there will definitely be a downside coming in from the newer stores that we open up until unless they don't stabilize. So for the next couple of years, we are not worried about this number. So what we are looking at this EBITDA at least to be positive for us for the next couple of years. That itself is good enough for us to sail through in Delhi as a market. So that's the plan for now.
Sure. I completely agree with that. So if you look at probably on the future expansion plans into North market, so just to understand from a return profile point of view, are we looking to buy out properties? Anything we have identified so far, or we will continue to work on the lease model?
Sir, majorly it's going to be on the lease model itself because right now, say, our expansion is happening at the periphery like Najafgarh, Burari, Nagoli, a few areas outside Gurgaon. So those areas definitely would be a rental model only. But the clusters, as I said on previous calls also, the clusters where a competition is quite big or where the clusters are of a certain size, where we feel that, say, if it's a cluster where Reliance Croma, Vijay Sales or any other local partner put together is doing 100-200 crores as turnover, those kind of places we would like to buy our properties because that is where the competition is going to be intensive in the future and the markets are going to keep growing. So for a smaller cluster, we are not interested to buy. Only on bigger clusters which are upwards of 100-200 crores, that is where we would look at buying out. But right now, major expansion of buying out in the major pockets of Delhi has been completed, like Lajpat Nagar, Janakpuri, Pitampura, Rajouri. We've completed only 1 or 2 locations in Gurgaon are left right now. But at the same time, we're not able to find a property. So probably once we do it, we might buy out those properties if required. But apart from that, there's no major plan of buying out properties in Delhi.
Right, sir. Sir, last question. So if I look at the Indian home appliances space and probably the categories in which you are present into, so normally what we expect is like these categories are likely to grow into double digits in volume terms. Now, when I look at your guidance, probably not guidance, but the aspirational target of SSG of close to around 10%. So obviously that goes well with the category growth rates, but also on the other hand, you do agree that there has been a shift happening from general trade to large organized players. So that should actually lead to higher SSG numbers on a sustainable basis. Correct me if I'm wrong or probably I'm missing something on the understanding part.
Manojji, very well said in terms of, you're absolutely right in terms of the market moving and shifting from the general trade to organized trade. But then two things, it depends on the particular category. Like mobile phones, definitely yes, are moving from general to larger format stores majorly. But when you consider consumer durables, especially in the modern cities or developed cities, already 90% plus share is with the organized retailers. So only limited share is with general trade partners for consumer durables specifically. Again, kitchen appliances as a category is a general trade market today. Talking about mixie, geysers, that kind of category is still with the general trade, very predominant with that category. If you're talking about tier 2, tier 3 towns, if you're talking about underdeveloped markets or cities which are just about to grow now, or states like Odisha, Goa, these kind of places, or if I talk about East completely, apart from Calcutta as one city, all these are driven by general trade players, or even up north, upwards of Punjab and Jammu Kashmir, Haryana, that few of the belts there, is all driven by general trade markets. But the market that we've been operating predominantly, majorly say in AP Telangana, are all majorly organized trade markets. So I would not say that the consumer durable growth there would be coming in from majorly, or we would have to grow a little more higher. But mobile phones, that shift you can see because the ASPs of mobile phones have shifted now upwards of 28,000-30,000 rupees. So that kind of sales of phone, people would not want to go to a small mom and pop store. They would like to go in a bigger format store, experience the device, check on the financing options there, see all the other offers, cashbacks and stuff like that, and then particularly buy from a bigger store and not from a smaller store in that category at least.
Right, sir. So thanks for the detailed answers and
Thank you, Manoj.
all the best, sir.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Miyush Gandhi from Cognizant Capital. Please go ahead.
Hi, am I audible?
Yes.
Yes.
Hi, Karan. Congratulations on execution here. Very good job there. I just wanted to understand the free cash flow that we've reported for 9 months seems to be a very big number. So, does this go down in Q4 before we fill the inventory for the AC business?
Hi, Piyush. So thank you very much. Yes, definitely, Piyush. So definitely in Q4, we've already started stacking up a lot of inventory for air conditioners, and we're seeing a little favor of summer falling in place in this region at least. So by the end of Q4, you'll definitely see a similar number that you've seen last year at the end of 31st March, or probably a little higher. But in the same line only, because AC and cooler needs to be picked up and kept as an inventory available with us. So we will see definitely a decline in the cash flows there, and increase in the inventory levels during that period. And Prem sir, our CFO, would like to add something there, please.
Sir, normally what happens at the end of the season, you can see the free cash flows will be on a higher side, but at the beginning of the season, it will definitely go down. That is the scenario.
No, that I understand and completely appreciate it. What I was just trying to figure out was that given that this year our margins are much better than last year, do we end up in a free cash flow positive situation, or you still feel we'll still be negative? That's
It will be positive. Definitely, it will be positive. And second thing, that's what. So it will be positive.
Okay, fair enough. Karan, I just wanted your perspective. The general understanding in the market, at least from the FMCG side of the business industry, is that there's a slowdown in the rural areas. We also have substantial operations in rural areas. So what is your sense? Is that K-shaped recovery something which you are also observing, or it's not true for the consumer durable space?
Till now, we've not felt that. In the last 6 months also, we've not seen that the consumption has reduced, or we don't see that effect in the stores there. Definitely, yes, the tier 2 stores that we opened are majorly in the last 2 quarters only. For us to judge also and tell them, because the base is zero there for us, and we just started operations, so definitely we would see a growth coming in those stores month on month. But probably if I tell you an example of where we've been operating in tier 2, tier 3 towns for the last 4 or 5 years, few of them, even they are growing, and there's a demand especially for premium products increasing in those sectors there. So I'm talking about 85 inches, 75 inch televisions, talking about side-by-side refrigerators or Apple devices or high-end mobile phones. So there definitely we see an increase, so we don't see a slowdown there at all. So that momentum is quite positive for us even in tier 2 and tier 3 towns.
Oh, okay, fair enough. And did I correct me if I'm wrong? You mentioned 35 stores for 25 financial year. Is that the number we should look for, or that's a little higher?
So like this year, we've already opened 21 stores in the first 9 months of this year, and then another 7 out of which were in the last quarter. We will end up opening another 7 to 10 stores in the next 45 days, out of which few of them we opened last week as well. So 30, 35 plus is very comfortable that we'll open. We've already identified, the paperwork is done, so there are already 10 stores in the pipeline that will open up in the next financial year, because they're getting ready, so they won't be opening up before 31st of March. So that's why we know that out of the 10, 12 stores will open up next year, which are already signed up for. And then another 20 plus locations is what we've identified across Delhi NCR and AP Telangana. So we are quite confident that we very comfortably will end up opening 30 plus stores in the next financial year as well.
Oh, so 35 we are talking about this financial year. Because we were at 21, we said 7 odd are ready, and then we would reach to 28, and then we were saying another 7 will get open. So 14 stores in this quarter itself. Is that right?
No. So 21 we opened in the first 9 months of the year.
Okay.
Out of which 7 we opened last quarter itself.
Okay, that's so 28, around 28 odd this financial year, 24, and 30 yes. Odd or 30 plus in the next financial year. Would that be a fair understanding?
Yes, yes.
Okay, fair enough. In the last couple of quarters, we had actually disclosed this revenue from sale of these warranties and guarantees by these offered by these third parties. Would it be possible for you to share in this quarter how has that number moved? Because that was kind of adding a profit.
Yeah, I'll take it offline with you, because I don't have the exact number right now, because we have increased our sales for other categories that would include accident warranty, accessories, audio, and one head. So that overall put together, there is an increase of almost around, quarter to quarter, there's almost increase of around 24-25 crore rupees, out of which you could attribute, say, 50% of it towards extended warranty and 50% of it towards other categories.
Okay, fair enough. Fair. Yeah, that's it from my side, and best of luck for the future.
Thank you, Piyush.
Thank you. The next question is from the line of Rajvi Shah from Bright Securities. Please go ahead.
Thank you for the opportunity. I just had a couple of questions. The first one is, can you shed some light on the product mix this quarter as many festives were there?
Yeah. So the mobile mix was around 40%. The large appliances was around 44%. And other categories was around 14% for small appliances and IT and other category. So that was a major split this quarter. So there was a decrease in the large appliances as a category and increase in mobile as a category, mobile and IT. Large appliances, televisions grew, whereas refrigerators and washing machines were more or less flat only this quarter. The ASPs went up though in that category, but the volume of that product category in refrigerators and washing machines were more or less flat.
Okay.
And air conditioners was the maximum growth if you look at Q3 versus Q3. So air conditioners grew by almost 50%.
Okay, so I just had one more question.
Yes.
What guidance can you give on the future revenue growth?
So guidance for the future revenue would be in same line that we've been delivering in the past. Probably a little more, I would not say we're not going to go a little more aggressive, because the majority of stores coming in the next few years would be in Delhi NCR region. So the market size is big there though, but it will take us a little more time to establish those stores and make sure that, they reach a certain threshold that we expect them to be at. So for the next, couple of years, we would be in the same line. So we would not go aggressive in terms of the numbers, but because the store expansion, the contribution from the store to develop over a period of 12-14 months and then start delivering us the expected numbers would be there. So we would be in line with what we're doing right now, and for next couple of years, that is the strategy.
Okay, that was helpful. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Dolly Chaudhary from Nivesha Investment Advisors. Please go ahead.
Hello, sir. Thank you for the opportunity and congratulations on a great set of numbers. I just had one question. So, as we know, the NCR is a big market for the company, but at the same time, I think it's very competitive also. So I just wanted to know what specifically company is doing to attain the market share there.
So, Dolly, I would say that is a business secret, so I would not like to, but actually, on a serious note, see, it is a technology product that we're selling, right? So, most importantly, you got to sell a product category that is prevalent in the market today, the brands that are prevalent. Customers come in for an experience, that is what we try to improve. So right now, we spend a lot of money in our back end, in our front end, store experience, product categorization, add up new product categories, bring everything under one roof, give a better retail experience. So that way, not only we're competing with our offline peers, but even competing with the online space as well. So that is really important that your after-sales service, your team on the floor, everything makes a lot of difference when you want to compete against your competition. And price is not just one factor. Majorly, if you ask me, we never consider price to be a major factor in differentiation. I think the product makes the brands that we deal with, the new categories that we've launched, and growing in those product fronts, giving out the best service to the customer, that is all put together is what makes a lot of difference.
So, overall, we are targeting on customer experience.
Yes. Like, for example, in terms of, not only that, but in terms of marketing, now we started spending a little more on, say, Google ads, a little more on YouTube, a little more on digital than the predominant print media that we used to do. So we try experimenting with that as well quarter to quarter. We are doing a lot of events, like last week just finished a Comic-Con event, where we attracted a lot of people, over 80,000 walk-ins were there for that event, where, there were kids between 18 to 24 years of age who are pure gamers, so we could increase our gaming laptop as a category. So it's smaller events, but we're trying to strategize individually for every category. Like for kitchen appliances, we're doing events for cookery shows and stuff like that. For every category, we want to emphasize our depth of product displays that we have, conducting individual events, so just apart from the regular prints or radios that we've been historically doing.
Right. Thank you. That was yours.
Thank you. The next question is from the line of Pooja Kamdar from GC Securities. Please go ahead.
Hello, sir. So, sir, I just have one question. So, have we encountered more sales through credit facility on YOY basis? And what percentage of revenue is it?
So not much of a change, Pooja. This is probably hardly a difference of 1-2% increase in the credit card sales, whereas NBFC still remains the highest contributor. Second would be credit card. Third would be wallets and cash. So NBFC still is the prevalent category for us.
Okay. Yeah, that was helpful. Thank you.
Thank you. That was the last question for today. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you. So I would like to thank all of you for joining into the call. I hope that we were able to answer all your questions. And for any further queries, you may get in touch with our team or SGA, and we'll be happy to address all your queries. Thank you once again. Thank you.
Thank you. On behalf of Electronics Mart India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.